Today in this video, I'm going to tell you the 5 best fixed income investments, so let's start. The historically low interest rates we're experiencing in 2020 are showing no signs of slowing down. Fed Chairman Jerome Powell recently announced his determination to maintain rates at a minimum until 2023. Meanwhile, real yields on government bonds or yields after inflation are negative. The extreme low rate environment poses problems for investors in fixed income, particularly those who are in the process of retiring or who are already retired. While there isn't a magic remedy, you can choose from a variety of options to think about as you navigate through these challenging waters. Adjust your expectations. The best way to begin investing in fixed income during a period of low rates is by setting the appropriate expectations. With 30-year Treasury yields at or below 1.5% and short-duration yields less than 1%, it's not realistic to expect a 5% return from an investment that is low risk. There are a few fixed income investments that offer higher returns. As we'll learn later, however, they carry more risk. The risk of taking on more may be an appropriate option in certain instances. It is, however, important to be aware of these risks and how they could impact your overall portfolio and your investment objectives. For investors with fixed income, that could include taking on slightly higher credit risk. With the Fed currently openly urging more inflation, the risk of inflation will likely increase over a long time. After we've rearranged our goals, it's time to take a look at the 5 top options for fixed income investments for investors looking to increase their returns. 1. Certificates of deposit. Certain certificates of deposit, CD, might provide slightly more interest over savings accounts. They also permit you to set the rate in place for the duration of the CD. It could be a problem in the event that rates begin to rise yet again. But rates are more likely to remain to decrease this year, which makes it an ideal choice to secure rates for at least one portion of your fixed income portfolio. There are rates that are as high as 0.85% on a 1-year CD. Remember that rates change daily. A CD ladder is an excellent method for investors to avail higher interest rates on long-term CD and still have access to the cash and certificates. As they age, there are also CD with special options, such as no penalty CD, that are not subject to a penalty when you take your money out before the time of maturity. Bump-up CD allows savers to increase the amount of the CD for the duration of the contract in the event that rates increase. Based on the duration, you could be able to bump rates twice over the duration of your certificate. Be aware that these options typically have somewhat lower APRs. 2. Online savings accounts. The present yield on a month-long Treasury bill falls below 0.10%. That's about the same as average APY traditional banks provide on the savings account. However, online banks have a tendency to offer much more lucrative rates. While the APY on online savings accounts are lower than historical norms, the FDIC-insured savings accounts are the security of earning an extra 5% on demand deposit accounts. The most competitive rates for savings accounts online currently are 0.50% and 0.80% in APY. Remember that the real rates, which are after accounting for inflation, are negative. Banks online, however, can offer rates much higher than government bonds that are short-term or the majority of money market accounts. 3. Defined maturity bond ETF. The exchange-traded bond fund. With defined maturities, an ETF is a fund that combines the convenience of bond funds along with the control of each bond. Much like a bond fund, ETF invest in a multitude of bonds in the same fund. The defined maturity bond ETF provide a specified time period at which the fund will close and their net assets go to the shareholders. The most well-known fixed maturity bond ETF is Bullet Shares that are provided by Invesco. Bullet Shares ETF give investors the possibility of investing in corporate, high-yield emerging market, corporate, municipal bonds. For these kinds of bonds, the maturities vary between 1 and 10 years. The yields are depending on the nature of the bond and its maturity. For instance of this, Bullet Shares 2025 Corporate Bond ETF BSCP currently yields around 2.2 bullet shares 2025 corporate bond ETF. BSCP currently has a yield of 2.21%, whereas the one which matures at the end of the year 2022, BSCM yields 2.2%. Like CD ladders, you can also ladder these ETF. 4. Corporate bonds. If you're in the market for bonds with better yields, an alternative is a corporate debt with an investment grade. They are issued by businesses with strong balance sheets and cash flows. Although the probability of default is higher than Treasury's investment-grade bonds are considered to be reasonably secured from default. The yield currently on the 10-year Treasury is approximately 0.70%. The yield on a 10-year investment-grade corporate bond is barely under 2.0%. As with Treasury bonds, corporate bonds come with the same risk of losing cash when interest rates rise. To ensure the maturity of the fund over time, fund managers continuously buy and sell bonds. In the context of rising rates, selling bonds can result in locking the fund in losses. Because of this, some investors would rather put their money directly into bonds, which they can keep until they reach maturity. This gives investors greater control over their investment, but it can also be costly and lengthy. 5. Municipal bonds. Municipal bonds are a great investment option, offering more yields as well as tax advantages. The income from municipal bonds is typically tax-free at the federal levels, however. It could also be free of taxation at state levels. This means that rates for munis are typically less than similar bonds. For those who are in higher tax brackets, the munis market could be a good investment option on an untaxed basis. This implies that munis must be kept in tax-deductible accounts and not the tax-advantaged accounts for retirement. If you are evaluating your investment strategy for fixed income, it's essential to consider the reasons you're including bonds in your portfolio. While earning a constant stream of income is certainly a good factor, diversification is another. Bonds are typically used as part of an investment strategy to reduce the risk of an investment portfolio. Because of this, the majority of investors focus on Treasury and high-quality corporate bonds. If you are looking for yield through high yield as well as emerging market bonds, be aware that the risk of volatility will increase, and the decision to allocate excessively your fixed income portfolio to unstable instruments could negate the advantages you wanted initially. There are some best money-making ways and trading options given in the description below, so don't forget to check them. If you liked the video, then like and share it, and give your opinion through a comment. If you haven't subscribed to this channel yet, then do it now, and also press the bell icon so that you can get notifications of my future videos. Thanks for watching.